Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominic Tavella, with additional insight from industry veteran Jordan Kimmel. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts.
And good evening. I'm Michael Hartzman. Today is Tuesday, July 27th, 2021. And this evening, sitting in for Dominic Tavella is our head portfolio equity strategist, Jordan Kimmel. Good evening, Jordan.
Hey, great to be with you, Mike, and not really filling the shoes, just kind of stepping in, and really glad to be with you and provide a little extra tonight.
I appreciate the assistance. So, Jordan, I know you're an equity guy. That's your bread and butter. And right after the close tonight, we had three big companies report earnings: Google, Apple, and I'm leaving one out.
Microsoft.
And they all look pretty good. So what's your take on these big companies that you constantly say there's got to take more than these 4 or 5 companies moving the market? But looks like they're going to do it again tomorrow.
Right. Well, look, pretty good all around, Mike, you have to say. When it comes to earnings, we all know right now that there's a combination of easy comparisons, but more to the point, these are tremendously profitable companies doing a amazing amount of business. And it's not really only confined to a few companies, which are right now seem to get all the attention and almost suck all the money out of the rest of the companies. But I think the whole S&P's on to a pretty good start to earnings season. And I think we're just expecting more of the same. The question is their guidance going to be good? And how can they possibly follow up and do better than this next quarter?
And we've been hearing that, I feel like, for a year and a half. Like, what are they going to do for an encore? Can they possibly do better? And yes, there's been some stumbles along the way, but the trajectory for the last several years seems to remain strong, right?
Well, taking it one step further, Mike, we've both been in the business an awfully long time. We should not forget to count the blessings. We're at new highs basically yesterday, the S&P, the Dow, the NASDAQ. These are all-time highs. It's not always this good. But yeah, right now you have alternatives in the bank and the bond market, not that attractive. And more people are asking, how could I get some kind of return? So this is a story I think we've been hearing for years. We might continue to hear it for years. And I love to call this another leg up in the unloved bull market.
The unloved bull market. Dominic asked me 2 weeks ago, what are you worried about? and I said I was kind of worried about the Delta variant. And that's kind of, if you look at the glass half empty side of the picture, it's the Delta variant that's kind of been creating a black cloud over the market the last couple of weeks and days, not slowing things down terribly, but it's kind of lurking. It's kind of like the music from Jaws. Like, you kind of know it's out there.
I love that. I love what you're saying. But Mike, hold on a second, right? When you create financial plans and we have our clients, and this is who we work with, the whole idea is to get them to kind of tune that music down and to realize there is a tomorrow. Whatever the headlines are kind of talking about today and emphasizing about today becomes the rear view mirror. And what is more important is, number one, constructing a diversified portfolio in terms of allocation, and then inside that allocation, getting that right too. It's a lot to ask for. That's what we try to do at Lebenthal. And that part of the movie, Mike, the summer movie, I haven't been in the water since Jaws. So look what that did to me. And you don't want to be out of the market for all this time.
No, of course you don't want to be out of the market, really for any extended period of time, because it never really works out. Because, as we always say, no one rings a bell to tell you when to get back in. And it sounds so simple, but it really just boils down to diversification. as
But
always.
one more thing, Mike, right now, I think it's so important. You know, you're hearing about these all-time highs. You're hearing about other things, crypto, even beyond crypto too. So people maybe are trying to keep up too much with the NASDAQ, too much with the QQQ, and maybe taking a little bit too more of a risk-on approach than they should at this point. And I think this is where it really takes an advisor, frankly, a professional, to kind of keep everyone diversified when they basically say, Mike, give me the reason why I don't sell everything and put it all in 4 stocks. That kind of scenario usually results in a bad ending.
It does. It does. So on that note, I'm looking forward to tonight's show. I'm going to be interviewing Lee Rubenstein, who's a friend of ours. He's been a divorce attorney for over 30 years. We're going to cover a topic that honestly we haven't covered before, but we all deal with in our practices. And then you, Jordan, are interviewing Herb Blank from ValuEngine, and you can pick up the topic of the market with him. And we will be right back with Lee Rubenstein.
When you're thinking about where to park your cash, for over 30 years in the business, I've been a fan of funds like the Lebenthal Ultra Short Tax-Free Income Fund. It's managed for cash and designed so the interest income you receive is free from federal taxes. And who doesn't love paying less taxes?
Mike, generating interest that's free from federal taxes is appealing. But I've been in this business for a long time, and people love the potential for more income on their hard-earned cash.
Sorry, Dom, but the beauty of the funds is paying less taxes on cash.
No, my friend, it's the potential for more income.
Less taxes.
More income.
Less taxes.
More income.
Less
For
taxes.
your cash,
More income.
ask your advisor
Less
about the Lebenthal
taxes.
More
Ultra
income.
Short Tax-Free Income
Telling you,
Fund,
less taxes.
or find out more at dcmadvisors.com.
Well, Dom, one thing I know we agree on, it's not what you earn.
It's what you keep.
Lebenthal Ultra Short Tax-Free Income Fund, symbol LETAX. LETAX. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
All right, I'm Michael Hartzman, back with Lee Rubenstein, a matrimonial attorney for the last 30 some odd years. Good evening, Lee. How are you?
Good evening, Michael. It's great to be with you.
Thank you very much. I appreciate it. You're an old friend of our practice, and I appreciate you coming on. And when we talked about this a few weeks ago, and you said some of your list of questions, I had so many that I literally had to pare it down to a few that I thought would be most appropriate. Divorce is an unfortunate part of every financial advisor's practice. I probably get a call once or twice a month that a client's either thinking about it or going through with it. So I guess, Lee, my first question for you this evening is it as simple as a married couple has been together for some odd years and they just split everything 50-50 and go on their merry way? It always seems to be a little more complicated than that.
Well, it is a little more complicated, and I'm going to speak specifically to divorce and property issues here in New York, because the law does vary from state to state, and I'm licensed to practice in New York and have practiced in New York for over 35 years. In New York State, we follow something called equitable distribution. And equitable does not mean equal, does not necessarily mean equal. It can be a 50-50 split, and in many cases it is. but you're not starting with a presumption of 50-50. And for instance, community property, which is applied out west, most notably in California, they do start with a 50-50 presumption, but equitable distribution does not. And unlike, say, calculating child support or maintenance in New York, where you have formulas that you can follow for guidance, there are no formulas in terms of splitting assets in New York. There are a series of factors that the court will look at, and they will apply the factors to each case. So it basically can be fact specific based on each case. Some of the factors are the length of the marriage, age and health of the parties, presence of children, need for one spouse to stay in the marital residence, most usually to care for children, an issue of whether or not one spouse sacrificed a career or possibly sacrificed their career potential to stay home and raise children. There are tax consequences, loss of inheritance rights, wasteful dissipation of assets or transfer of assets in contemplation of divorce. So there are a series of factors that the court will look at before arriving at a distribution. However, having said all that, in cases where you have a long-term marriage, and generally a long-term marriage is more than 10 years, generally you're looking at a 50-50 split.
So
But there are other.
I have two follow-up questions to that.
Sure.
One, does someone's bad behavior matter?
Well, when you say bad behavior, that's a relative term. It can. Usually it doesn't, but it can. It really depends on the facts. Also, to the point you raised a few minutes earlier, there are two classifications of property. There's marital property and separate property.
Mm-hmm.
Marital property is all property acquired during the marriage, except for inheritances, gifts from third parties other than your spouse, and personal injury awards. So marital property generally has a Big Ten definition. However, separate property, and that's property that you either have when you got married or property that can be traced back to separate property, property that you can acquire during the marriage but can be specifically traced back to premarital property or separate property. Very often you have an issue of the appreciation of separate property. So somebody owns a business before they were married, and that business has a value as of date of marriage, and then the parties are married for, say, 20 years, and the business might have been worth $1 million as of the date of marriage. 20 years later, it has increased in value significantly. So now you're looking at the appreciation of separate property, and unless the non-titled spouse, let's say it's the husband's business, the wife is then the non-titled spouse because she doesn't own the business, it's not owned in her name, unless she can show some kind of direct active contribution to the business, even if it appreciates in value, as the non-titled spouse, the percentage that she may receive of the appreciation is going to be very low.
Mm-hmm.
So the facts really come into play.
Okay. One call that I get every now and again is a client will call me up and tell me in confidence that they're contemplating getting divorced and they want to hide some money. And I always say to them, that sounds like a terrible idea. It's not 1935. You can't walk out with a satchel of cash. How are you going to hide money? And I'm not a lawyer. I don't play one on television. I don't have a law degree. But just my instincts say I should tell my clients that sounds like a terrible idea. So is it a terrible idea?
It is. And one reason why it's not a good idea is that the law provides for what's called compulsory financial disclosure. Both sides have to fill out a financial statement. It's called the Statement of Net Worth. The form itself is 20 to 25 pages long. It's required if you go to court and litigate the case. But what good matrimonial lawyers will do early on when they first get hired is they'll have their client fill out the form, even if the parties aren't planning on litigating. You know, many cases can be settled without walking into court. But even in that instance, you still have to have full and fair financial disclosure, because if you're negotiating a contract, the ultimate terms are based on information available to both sides. So before you start the negotiations, the lawyers will exchange statements of net worth. They're even prepared if parties go into mediation, which has become very popular today, alternative dispute resolution, whether it be straight mediation or collaborative law. Very often, usually, financial statements are exchanged. And there's toward the end of the form, there's a section that says assets transferred within the past 3 years. Have you transferred any assets? Sold them and then taken money and moved money around, or transferred title to another party, or possibly taken a loan against the asset. But the specific section on the form says assets transferred, and it's a 3-year look back. So if you lie on that and you're not truthful, or you have transferred and you don't disclose, and then you've got to sign that document under the penalties of perjury. It's an affidavit. So I don't recommend. I don't recommend going down the road of hiding and secreting assets and not being not being truthful.
Okay, I had a
Or
feeling.
if you're going to do it, if you're going to transfer an asset, you're going to have to disclose it.
Right, I had a feeling you'd say that. So one thing that we deal with a lot in my office are quadros. QDRO, if I remember correctly from my CFP estate planning class, stands for Qualified Domestic Relation Order. And I think
Correct.
Thank you.
That's correct.
Thank you, sir. So I think I've expired my knowledge of what a quadro is. So could you, for the benefit of our audience, kind of explain how that works? And one thing I do know is they come with an expiration date, and they are a little complicated, not that easy to acquire, but really, really important when one side or the other has retirement accounts. So can you get into that a little bit?
Michael, exactly. When it comes to retirement assets, and that's very common. Most parties, when they're getting divorced, they usually own their home and they have retirement benefits. Those are the two major assets before you get into portfolios and other types of investments, business interests, etc. Most people have some type of a retirement asset. And retirement assets are subject to being equitably distributed in New York, as in other jurisdictions. And if you have a retirement asset that's held in a qualified plan, and you may be able to speak more to what a qualified plan is, but if you have assets in for instance, a defined benefit plan, or a 401k plan, those are two common examples.
Right.
In order to divide them, you will need a quadro. Now, how does the division take place? Let's assume one spouse is a teacher and the other spouse has worked privately and has an IRA. If, let's assume the husband has the IRA, the wife is the teacher, she has the teacher's retirement system benefits. The husband is entitled to a portion of the wife's benefits, and the wife may be entitled to a portion of her husband's. Again, the marital portion, that portion that accrued during the marriage. Now, you can offset value. You can look at what the husband would owe the wife and what the wife may owe the husband. And let's assume the wife, as the teacher, has the greater benefits. So ultimately, she's going to owe her husband some money after offsetting what the husband would have had to pay her. You need a quadro so that the husband, as a result of the quadro, which will ultimately be signed by the judge in the case will sign it. The last letter is O for order, which means court order. So the judge will sign the quadro. And generally, they will sign them after the judgment of divorce has been issued. But you have some unusual circumstances where you can ask a judge to sign before. But the
So
reason
someone,
that's,
just to be clear, a couple have
Yeah.
to be officially divorced, and then the quadro is issued.
yes, because the court will want to see a certified copy of the final judgment of divorce, which that's the proof that the marriage has been formally dissolved.
Got it.
If you sign a separation agreement or a stipulation of settlement, that doesn't end your marriage. Only a judgment of divorce does.
Got it.
So in order for the quadro to go through, the judgment of divorce has to be signed. In very unusual circumstances, you can get it done earlier. But what happens with a quadro is the non-titled spouse, let's assume again it's the husband, he becomes a participant as a result of the quadro. He becomes a participant in his former wife's plan, and they do a carve out. The plan administrator of the wife's retirement benefits in this example will carve out the amount that the husband will be entitled to, and that will all be set forth pursuant to the quadro. Quadros are sophisticated, specific documents, and good matrimonial lawyers do not prepare them.
Mhm.
They are prepared by actuaries, and there are companies that will provide, as among the services they will provide, usually along the actuarial line, in valuing pensions and managing pensions. They will also very often provide the services of preparing a quadro. So the lawyer will work hand in hand with this particular expert, who will charge a flat fee at the end of the case. If the case is settled, it'll be based on the terms of the settlement as they relate to the pension assets. A quadro gets prepared, and then the plan administrator must pre-approve it before the court will even consider signing it. Because if the plan administrator doesn't approve it, they won't effectuate it.
I guess it's useless.
Correct. It has to pass a muster with the plan administrator. And one thing that I've seen in my practice over the years, and I've seen it a couple of times, the lawyers spend a lot of time, obviously, trying to reach a settlement. They negotiate a settlement. Ultimately, the terms are memorialized in the stipulation of settlement. A lot of work is done. The stipulation is finalized. And then the papers, a separate set of papers gets prepared to finalize the divorce. Because remember, as I said earlier, the only way the marriage formally ends is with a judgment of divorce. So a separate set of papers has to go to the judge following the finalization and signing of the stipulation of settlement. Very often, provisions are made for a quadro. There are lawyers who will, at the end, they've spent all their time getting the stipulation signed, and they've gotten the judgment signed and entered, and they kind of put the quadro on the back burner. And sometimes, unless the clients are diligent and will follow up with their lawyer and say, okay, you did all this good work for me, and you've gotten a settlement, and now you've got me divorced. What about the quadro? Let's get the quadro done. If you've got more than one plan, I had one case recently, the husband had 7 different plans.
Wow.
They all had to be, we needed quadros on all 7 in order for the wife to get her share of the benefits. A lot of work had to go into getting those quadros prepared because they were with different plan administrators, and each plan administrator had its own rules. Unless the lawyers stay on top of it, the spouse who's entitled to the benefits can end up at a disadvantage if the quadros aren't prepared properly.
Or, Lee, what I've seen also is the stock market's been doing so well that these quadros get negotiated, and depending on how they're negotiated, one side or the other might wind up with way more money right now. And, I've been doing this during bear markets, and clients have wound up with way less money because people agree to the quadro, but no one calls a financial advisor and says, oh, you carve out this piece because this is part of my divorce, and it stays fully invested, and that may not have been the intention. So these quadros, not only are they time consuming, but the best laid plans could go awry if that one last dot isn't dotted.
Well, to that point, Michael, specifically, language should be inserted in a stipulation of settlement after the amount is determined. And sometimes you can determine a sum certain, sometimes you can't. Right. Sometimes the best you can do very often, especially when it's a qualified plan, is you'll say, that the husband will be entitled to 50% of the marital portion of the wife's plan.
As of this
Because
date.
a pension plan, you can't come up with a sum certain that easily. 401k plan is different. You can look at the statement. But then here's the magic language that needs to be included. 50% of the marital portion of the other parties or the other spouse's interest, plus or minus gains and or losses up until date of distribution.
There you go.
So
And that's what
you have a-
I've seen it. That is not in there frequently. Because
right. Well, it should, but it should be.
I know.
Because what will happen is you can have a cutoff date.
Mhm.
Cutoff date is generally date of commencement of the matrimonial action. That's when the clock stops for calculating and determining marital property, date of commencement. But it could be years until the quadro was finalized. And that could be because the case could be litigated. Very often matrimonial cases can take at least a year or more to settle. And if they go to trial, even longer. Ultimately, you get a settlement or a decision after trial. The market could have changed. You want to make sure the quadro reflects that if the interest on the marital portion, if it appreciated in value due to market factors, strictly market factors, the non-titled spouse doesn't lose out. Conversely, if the market goes down, you don't want the non-titled spouse to get a windfall.
Exactly.
So you put the appropriate language in, both you put it in the stipulation of settlement, which will then be mirrored in the quadro, saying plus and or minus gains and or losses from up through the date of distribution.
We have less than a minute to go. So the last question is, these things do come with an expiration date, do they not?
When you say expiration date, Michael, what do you mean?
The judge's order basically says, this quadro is in effect from this date to that date. We have like 30 seconds. Or is it quadro?
No, generally not. I processed a quadro recently for a woman who had been divorced for 20 years.
Got it. So Lee, believe it or not, I only got to about a third of my questions, so we're going to have you back. But before I let you go, I met you from your mom, who you told me just turned 95 years old. So God bless her, and tell her everyone at Lebenthal wishes her a happy and many more birthdays.
Michael, thank you so much. It's been a pleasure to participate today. Thank you for inviting me, and I look forward to appearing again.
We'll have you back, and your mom's probably going to kill me for doing that, but I couldn't help myself.
Thanks, Mike.
Take care, Lee. Have a great night. We'll be right back with Jordan Kimmel and Herb Blank.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
And welcome back to the Lebenthal Report. I'm Jordan Kimmel. It's a pleasure to be with you, portfolio manager and equity strategist here at Lebenthal. And I'm back with a good friend. It's Herb Blank from ValuEngine. And Herb, thanks so much for joining us.
It's a pleasure to be here, Jordan. Thank you for having me.
All right, terrific. And Herb, so you're at ValuEngine right now. You're tearing it up, really. You're writing some very insightful articles. We'll address one of them today, frankly. But I know you're a lot longer. You know Magnet and Facts, the details as almost well as anybody. And you've been through a lot of market cycles, and we've remained friends and colleagues through that. And so it's great to have you back on, really.
Terrific to be back on. Very interesting time in the markets. Very, every day is different, as they say, right?
Every day is different, but let's start with this. First of all, it's a little bit of a blessing, all-time highs yesterday in all the indexes, but not all companies are being treated equally, and people will look back and say a monkey could have made money in this market. A lot of people are not making money in the market. I want to dig a little deeper. We just hear this overwhelming value versus growth trade. So why don't you address that in an overall scheme, and maybe dig a little bit deeper, what is value? What is, in fact, growth?
Well, that itself is a definition that that has so many different points of view that if I named them all, we would be out of time. But generally, value is looked at in terms of a price-book ratio, was the classic way that the value anomaly was born. Then a lot of managers prefer to look at it as price earnings or earnings price, which there's actually less evidence for over time. Price sales works in some industries and not other industries. Dividend is something that's looked at, dogs of the Dow, also just negative price in the immediate period, which I think is the worst way of looking at value of a lot of the popular ones. But there are different things people consider in value investing, and now people are saying, well, the earnings statement, it doesn't have the financial statements were meant to do the manufacturing era. They're more than 100 years old. Inventories, capacity utilization, factory burnout, things, times interest earned. Some of those don't apply to the modern companies at all. And and that's one of the reasons you have the ESG, at least awareness trend and things like that, because the real value that many of the major companies have is their franchise name and their reputation, their intellectual property, their branding, their intellectual capital, and their patents. So these are things that are not part of anybody's value model, free cash flow model, or anything else. So
okay, but hold on a second here, Herb. This is a really, really great place to go to the next level. So although the price to sales and price to book, they're all, they don't transport across all industries. Intra-industry, it might still be a good way to value companies. But here's the point. You're bringing out this size, dividend, value, growth. So what you're talking about is the factors that we could actually separate companies from. And what I want to get into is I believe mostly in the quality factor. And so the concept is the market's just a gamble. It's just a casino, random. I don't buy that. I think there are ways you can use factors, create quality screens, and actually differentiate among companies and go to a more granular level.
Yes, I mean, active management and value can work. I just completed a blog that's available in Talk Markets and will be available next week in ValuEngine blog on a actively managed ETF by DoubleLine called DBLV that has been able to justify its 97 basis point annual fee versus the 19 basis point for the benchmark ETF by beating it over the last 1, 3, 6 months, 1 year, 3 year, and 5 year period. Now, the value indexes started to perk up the last 9 to 12 months versus the growth, but they're still lagging them on a 5 year basis.
Right. Well, Herb, I actually read that paper, and I thank you. You sent it to me, and in all kind of humor and transparency. I'm a client. We are a client, I should say, at Lebenthal of ValuEngine, and I have privilege of you peeking in the portfolio. And it kind of reminds me. I don't know whether it's because I'm getting a special Jordan Kimmel thing, or all ValuEngine clients get the same thing, kind of like the insurance commercial. It's everybody's good deal, but frankly, you looking into the portfolio and evaluating risk in what's getting into kind of a heated environment. And I want to address things where you actually at ValuEngine look at ETFs, rank them, individual companies, and they don't all look so appealing, not because they're not good companies, but because of the price they sell at right now.
We have our models have more than twice as many overvalued companies than undervalued in our 5,000 plus stock universe.
Right. So we're not saying we don't like these companies. We're saying it kind of matters what you pay for things, right?
And timing in the market matters more than anything else. It's the old thing. Well, there are a lot of people predicting a crash, and when it finally happens, they'll say, "I told you so." But how much did they lose before that crash happened by not being in the market? I mean, it's the old thing. Yeah, you can give a prediction in the market if you like, just don't give a date.
Well, or on the other hand, but importantly, we talked about this in an earlier segment, Herb. There's so much crazy news out there that there needs to be a way that you could actually comfortably have a portfolio of stocks, go to sleep, not worry about what's in tomorrow's headlines. And I think that could be done using a series of quality screens, looking for cash flow, increasing dividends, and really caring about what you pay for things. So, on that note, Michael, who has been around the market a long time, Michael Hartzman manages a very conservative approach, looking more for income for life, but appreciation. So if the engineer could bring Mike in, Mike actually, we have these meetings, Herb, not only for our clients, but we have these thorough meetings with our advisors. Okay. And today I mentioned there was kind of a move into FANGs and a lot of things got left behind. And we had a very engaging conversation about whether or not equal weighted, passive weighted, and I know you guys look, that study you did on active management, I think was really right on time.
Yeah, well, active management, all T. Rowe Price, Fidelity, J.P. Morgan, Goldman, Dimensional Funds, Franklin Templeton, they're all now finally embracing the ETF structure. And I will say that I wrote that the active management should start using the ETF structure and how and why back in 2001. So I just did a 20-year refresher on it now that it's actually happening and being embraced. Because
well, Herb, then before we bring Mike on, I have to say this, folks. Herb brought me into some meetings when ETFs were basically ideas, and it was behind the actual concept that you could mirror index returns with less securities. And then it turns out to be the question of how many less and what kind of factors do you use. So Herb was really at the birthplace of ETFs and said to everybody, watch the growth in this industry. And Herb, in the ETF industry, you are in fact a legend. I have to say it.
Well, the one claim to fame I have, such as it is that I was the first U.S. portfolio manager of ETFs, because SPY and MDY to these days are unit trusts. They have a trustee that runs them, not a portfolio manager. So we were the first Deutsche Bank with the country baskets.
Herb, one of the smartest always in the room. A pleasure to know you. And let's see what kind of thoughts and questions Mike has for you.
I'm looking forward to it. Good to see you, Mike.
Good to see you, Herb. Thanks for coming back. How are you?
Perfect. Well, just lovely down here in Florida. A little bit of a toasty day, but it's a lot of fun.
That's all right. It's the middle of July, I guess. That's what we get. What we get. I'm going to throw you a curveball. You guys are always talking about the most fundamental parts of the market: earnings, price projections, PE ratio. And then I get a headline. Literally, as I was waiting for you guys to come back on, my phone pops up that the New York Knicks are offering for the first time an NFT in history. And I still don't know what that is. I mean, Jordan, it's the analogy you used earlier today, how the artist sold an invisible piece of artwork. So Herb, how do you stick to your knitting, get your clients to stick to their knitting when they're getting, pieces of whatever from the Knicks that, in my mind, don't exist either?
Well, you have the Yankees Nets stocks, which had to do with the advertising and the media part of the organization, and Cleveland Indians have sold stock. I mean, it's not the most unusual thing in the world. Of course, Green Bay Packers own stock.
But Herb, these are these NFTs, which I believe are just pieces of crypto. I mean, they're not real, are they?
Yeah, the NFTs are actually, yes, a new phenomenon. And I don't know that they're not real, but there's no protection. Nobody's, who's standing up for it in credibility. If something goes wrong, who do you go to sue?
Right. Herb, what Michael's basically saying is we're in this environment where does value really matter at all? And really maybe the question is maybe not in the short run. Mike, there's an expression about the market being ultimately a weighing machine, and in the short term it's a voting machine.
Yeah.
And right now the votes are almost on tilt, but Mike's asking you serious questions. How do we rein in the risk when people are talking about NFTs?
Well, let's go back to 1999, and we were talking about, Qs and how they had the incredible 100% growth in 99, and then crashed like anything in 2000, 2001. And, over the last 17 years, QQQ was the way to be. And then maybe, someday is going to come where it gets incinerated again. When you play with lightning, you get the good part and the bad part, right? So, those are legitimate stocks. As you say, when we get to crypto, coin exchanges, things like that, that do not have, there's no DTCC there standing up. There's no insurance company standing up. There's no governance. There's no fiat currency standing up. It's, the Wild West. They can have these exchanges, they can put these things up, but there's nowhere to go if something happens. And, you're telling me that these technologies, and they're very sophisticated, these blockchain, internested blockchains, DNA helixes, that's wonderful and everything. And right now probably is unhackable. I don't believe there's any technology that's going to be unhackable forever. And what do you do once you get hacked and your money gets out on the crypto exchange? Again, who do you go to? Who's standing up for you? So I don't consider crypto an investment. I consider it a, what's the word you look at when you take a flyer on something and maybe it'll hit and maybe it's not. So you
it's a
have
lottery ticket. It's a lottery ticket is what it is.
In essence, or it's like, I'm going to take it to the casino and bet it on 35. Okay, it could work. But I don't consider that prudent investing. I go to a counselor, if I want to go to a Lebenthal, or if I want to even do it myself, or if I want to go to Schwab, no matter what I'm doing, you have to be prudent, disciplined, diversified. And, if you're talking that this is an investment, the reason people invest in the market is that on a long-term basis, it's always a positive gain, positive return. That's only, you can only count on that if you're having a diversified portfolio, a disciplined strategy. And if you watch CNBC, I recommend 2 wads of cotton, one for each year.
Right. And Mike, in great disclosure, when I talk to Herb, he reminds me, anyone who's trying to day trade the market is really mistaken. And the way to really go about it is a longer term approach. But there is also a belief that not only, like we've had Professor Siegel on talking about, he believes in ETFs with an index, but if you can even enhance the index and do a little bit better with risk management and keep clients out of trouble, Mike, that's our long-term goal. And keeping people in the game and not having them really kind of lose their place when there's too much risk and they left it all on the table.
Well, the double line is a perfect example. If you look at the portfolios, if you look where they are, they've consistently had a lower price book than even the value index.
Herb, so hold on one here. We have to make sure we're never making any recommendations on any individual thing. We've read the piece. We're going to have to thank you here. We literally ran out of time again.
Recommendation. I don't own it myself or anything like that.
But
I'm just saying, I was just talking about how the structure can work for somebody who has a disciplined approach.
Right. And we love doing the homework, but we don't make recommendations. So we want to thank you. We love having you on. We're having you on again. And keep cool down in Florida. Great to be with you.
Yeah, no, thanks a lot. And yes, discipline is the way.
Thanks, Herb.
Thanks, Herb.
We'll be right back, folks, with more Lebenthal Report following this quick break.
Are you paying federal taxes on your cash? I work hard for my money that I keep in cash. And for the life of me, I can't imagine why anyone would want to pay federal taxes on their cash. That's why I keep my cash in the Lebenthal Ultra Short Tax-Free Income Fund, symbol LETAX, LETAX.
Rates on cash are already so low, why pay federal taxes on the interest your cash earns? Remember, it's not what you earn, it's what you keep. The Lebenthal Ultra Short Tax-Free Income Fund, LETAX, may help you earn more on the cash you've worked hard for and keep more after-tax dollars in your pocket. Find out more about the fund by speaking with a Lebenthal Global Advisors private wealth advisor or its sponsor at dcmadvisors.com.
For your hard-earned cash, why pay the tax when there's the tax?
Lebenthal Ultra Short Tax-Free Income Fund. It's not what you make, it's what you keep. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
All right, I'm Michael Hartzman, back with Jordan Kimmel. Jordan, those were two obviously very different interviews that we did. Lee, I thought was pretty enlightening, talking about the different machinations when someone's trying to get divorced. And God, you live in a state where you're under this impression everything's 50-50, and you need to talk to a divorce attorney, and nothing is ever as simple as we think it is.
Well, you said it, and look, that's a conversation, frankly, I haven't had. I think it gets complicated, but some things, the less you know about them, the better. And when someone tells me they're not feeling well, I tell them I hope they're feeling better. And that might make me sound callous, but I hope they're feeling better, honestly.
So that's the advantage, Jordan, of being our equity strategist and just trying to figure out the best stocks, the best opportunities. When you're front facing, like Dom and I are, we literally, thank God I've never had this conversation in my own home, but I have this conversation probably once a month, once every other month with a client who's either contemplating it or just gone through it or been referred to someone who's gone through it. It's exhausting. The whole process is exhausting. And like I said, never as quick and never as easy as I think people like to believe.
Well, maybe the thing to do is sometimes to dial it down and to make it simpler. And people sometimes overthink and overcomplicate. But I think what the message from Lebenthal that I heard from day one was, it's not a matter of trying to get people rich quick. There's no shortcuts in investing. It really is just a stay on the road and stay disciplined and make sure you don't really take one of those side doors. So, we have a lot of, our meetings with our advisors who really are, very much in touch with their clients, who are hearing these things. Mike, you take for granted already because of your experience, and everyone listening even knows what an NFT is. There's a lot of side traps that are sneaking up and maybe distracting people. The whole idea of keeping on the longer term path and really looking for a nice rate of return, but making sure you don't really get taking too much risk, especially I think at this time of the market, is the key.
It's so interesting because, we always talk about how long we've been doing this. And I remember, I don't know, 10, 15 years ago, clients would call me up and say, hey, Mike, could you get me into a hedge fund? And everyone wanted to be into it. No one knew what a hedge fund was, but everyone wanted to be in a hedge fund, 10 or 15 years ago before the financial crisis. And that seems so quaint compared to now, where I get calls about, cryptocurrency, and 5 years ago, everyone wants to be in pot stocks. So there's always the hot thing that people want to participate in. You're right. It's our job to kind of say, look, if you want to take a little money, some of what we do, want to take a few bucks and do that. This is how you go do that. There was the gold rush we went through about 10 years ago. Everyone wanted to buy gold. And we're always living through, Jordan, these phenomenons. And this time it's these NFTs. And honestly, I know what they are, but I'm not 100% sure I even know what NFT stands for.
Right. Well, the key is too, Mike, is that I think it's super important for everyone to be aware of current events, aware of the risks. But sometimes I think the tongue-in-cheek advice I give is to stay off of page one, because page one is terrifying, and it's there to get you nervous. It's there to get you scared. But if I said to you, Mike, that I want to give you a long-term plan, and that's to stay in cash forever, you realize that's a real bad plan, and you have to figure out a way to get yourself invested in a comfortable way. And I think that's usually personally, I think it's through an advisor.
So Scott Hartzman just texted me. It stands for non-fungible token.
Oh, I know what they stand for, and I know and they're already selling for $69 million a pop. You can't put it on your wall, Mike. They did stick the banana to the wall a couple months ago, if you know what I'm saying. But this is a digital art, and it's $69 million a pop, and we're not advising it for our clients.
Absolutely not. So Jordan, next week we are taking the week off. We're going to rebroadcast the show we did with Harold Balachi, a state attorney, and we will all be back on August 10th. And Jordan, enjoy your break, and we'll be back August 10th with Dominic as well. Good night, everybody.
Look forward to enjoy your summer, everybody. Nice to be with you, and we'll see you in a couple weeks.
Thanks for tuning in to the Lebenthal Report.